Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Denied. That is the sound of the IRS rejecting your tax deductions. Here's a scenario I see all the time. A high-income earner, let's say a software engineer making $300,000 a year, listens to our podcast on cost segregation. They get excited. They buy a $1 million rental property, high-level tax architecture. So the standard warning applies. I am not a CPA and I am not a tax attorney. The strategy we are discussing today, reps, is one of the most audited areas of the tax code. If you do this wrong, the IRS will crush you. Do not attempt this without a qualified tax strategist guiding your hand. Understood? Good. Let's break the code. To understand reps, you have to understand the IRS mindset. The IRS assumes that if you have a full-time job, your real estate is just a side hustle, a passive investment. Therefore, you don't deserve the active tax breaks. To prove them wrong, you must pass the 2-part test, and you must pass both parts annually. Part 1 is the 51% rule. More than 50% of the personal services you perform in all trades or businesses during the tax year must be performed in real property trades or businesses in which you materially participate. In plain English, you cannot have a full-time W-2 job and qualify for reps. If you work 2,000 hours a year at Google, you would need to work 2,001 hours in real estate to pass this test. That is physically impossible for most people. This status is generally for people who work in real estate full-time. Part 2 is the 750-hour rule. You must perform more than 750 hours of services during the tax year in real property trades or businesses. 750 hours, that is roughly 15 hours a week every week for a year. And let's be clear about what counts as real property trade. It includes development, construction, acquisition, conversion, rental, management, leasing, or brokerage. If you are a full-time real estate agent, you probably qualify. If you're a full-time flipper, you probably qualify. But if you are a dentist who owns 3 rental properties, you almost certainly do not qualify on your own. So is the door closed for high W-2 earners? Not if you're married. The Spousal Super-Play. This is the single most powerful tax strategy for high-income married couples. I call it the Spousal Super-Play. Let's go back to our software engineer making $300,000. Let's say he is married. His spouse does not work a W-2 job. Perhaps they stay home with the kids, or perhaps they work part-time. Here's the play. The spouse becomes the real estate professional. The spouse takes over the management of the rental portfolio. They handle the tenant calls, the repairs, the bookkeeping, the leasing. They clock 750 hours a year doing this legitimate work. Because they don't have another W-2 job, they easily pass the 51% test. They pass the 750-hour test. They qualify as a real estate professional. Now, because they file a joint tax return, their status applies to the household's real estate losses. Suddenly, that passive loss from the rental property becomes non-passive. That $100,000 paper loss from the cost segregation study, which we covered in episode 103, can now be applied directly against the husband's $300,000 tech salary. Instead of paying taxes on $300,000, they pay taxes on $200,000. They just saved roughly $30,000 in cash by shifting the tax status of one spouse. This is how the wealthy operate. They build their life architecture so that one person drives the income and the other person drives the tax shelter. The material participation trap. Now, before you go tell your spouse they have a new job, you need to know where the bodies are buried. The IRS knows people try to cheat this. They know people claim reps when all they really do is check Zillow and drive past their properties once a month. To stop this, you have to prove material participation on your rental properties. There are 7 tests, but you only need to pass 1. The most common is the 500-hour test. You, the designated pro, must spend 500 hours participating in the activity of that specific rental. Wait, Martin, you say, I have 5 rentals. Do I need 500 hours on each one? That's 2,500 hours. Yes, unless you make a specific tax election called grouping. You can elect to treat all your rental activities as one single activity. This allows you to combine your hours across all your properties to hit that 500-hour threshold. But here's the trap. What counts as hours? Investor hours do not count. Reviewing financial statements doesn't count. Researching new properties to buy generally doesn't count toward the 750 hours. Traveling to the property usually doesn't count unless it's the only way to do the work. What counts? Work, fixing the toilet, showing the unit to tenants, supervising contractors, handling evictions. If you hire a property management company, it is extremely difficult to qualify for reps. Why? Because you aren't doing the day-to-day work. To qualify, you generally need to be the one managing the asset. The Audit Shield, the time log. If you claim real estate professional status, your audit risk goes up. period. If you get audited, the IRS agent will ask for one thing first: your time log. They don't want estimates. They don't want, I think I spent 10 hours a week. They want a contemporaneous log. That means a log written at the time the work was done. Date, time started, time ended, specific activity performed, which property. July 12th, 2 p.m. to 4:30 p.m., 123 Main Street. Repaired drywall in living room and painted Unit B. If you try to reconstruct this log 3 years later when the audit letter comes, you will lose. The courts have repeatedly disallowed ballpark estimates. There are apps for this: Toggle, Clockify, or even a simple Excel sheet on your phone. But you must be religious about it. If you claim reps, your time log is your insurance policy. It is worth tens of thousands of dollars. Treat it that way. Let's recap. Real estate professional status turns passive losses into active deductions. It requires 750 hours of work and being your primary job. It is the ultimate strategy for high-income couples where one spouse can focus on the portfolio. Your challenge today: I want you to do a time audit. If you think you or your spouse might qualify, start tracking your real estate hours for just 1 week. Be honest, only count the real work: maintenance, tenant communication, administration. Multiply that week by 52. Are you anywhere near 750 hours? If you're at 200 hours, you're not a pro, you're an investor, and that's fine, but don't file your taxes like a pro. But if you're hitting 15 or 20 hours a week, you might be sitting on a gold mine. Call your CPA immediately and ask, can we look at reps for 2026? Next episode, we are talking about the exit. You've built the empire, you've saved the taxes, but you're tired of the tenants. How do you sell, defer the tax, and never fix another toilet again? We're diving into the Delaware Statutory Trust DST. I'm Martin Maxwell. Keep learning, stay strategic, and keep building one step at a time.